Why your shopping cart seems to shrink every time you go to the store. Have you ever wondered why prices of goods and services increase every year? If your answer is yes, then you've experienced inflation firsthand. But what exactly is inflation, and why does it happen? Hey there. Welcome to WealthWise. Looking to boost your financial knowledge and make smarter money moves? You're in the right spot. Don't forget to hit that subscribe button and ring the bell to stay updated with all our latest tips. Inflation is an indispensable concept in economics, signifying the sustained rise in the general price level of goods and services over time. It influences every facet of economic activity, from the purchasing power of individuals to national policy frameworks. While moderate inflation is often indicative of a robust economy, unchecked or volatile inflation can disrupt financial stability and exacerbate socioeconomic inequalities. This video synthesizes foundational and advanced perspectives on inflation, offering a thorough understanding of its dynamics, impacts, and policy responses. Let's take a closer look at what inflation really is and why it's so important to understand. Inflation represents the diminishing purchasing power of money as prices rise. Metrics such as the Consumer Price Index, CPI, and Producer Price Index, PPI, are employed to measure this phenomenon. For instance, consider how a loaf of bread that cost $1 in 1980 might cost $3 today, illustrating the real-world effects of inflation. While controlled inflation is essential for economic growth, hyperinflation or deflation signals deeper structural problems, as evidenced by Zimbabwe's hyperinflation in the late 2000s or Japan's prolonged deflation during its lost decades. Now that we understand what inflation is, let's examine the causes behind it. The genesis of inflation is multifaceted, rooted in both demand-side and supply-side factors. Demand pull inflation. Demand pull inflation occurs when aggregate demand surpasses aggregate supply, driving prices upward. Key drivers include economic growth. During periods of economic expansion, heightened consumer and business spending can exceed supply capabilities. Government spending, fiscal stimuli, such as infrastructure projects, escalate aggregate demand. Monetary policies, low interest rates promote borrowing, increasing disposable income and fueling demand. Export demand, a surge in international demand for domestic goods can intensify demand-side pressures. Cost push inflation. This type arises when production costs increase, compelling businesses to raise prices. Influential factors include raw material costs, fluctuations in commodities like oil ripple through industries, raising costs. Labor expenses, higher wages in labor-intensive sectors elevate production expenses. Supply chain disruptions, natural disasters, geopolitical events, or pandemics can disrupt supply chains, exacerbating costs. Now that we understand the key causes of inflation, it's time to explore the different types of inflation and how they manifest in economies. Inflation can be classified based on its intensity and characteristics. Creeping inflation, with annual rates below 3%, creeping inflation fosters economic growth by encouraging spending and investment. Walking inflation, ranging from 3% to 10% annually, walking inflation erodes purchasing power and may necessitate intervention to prevent escalation. Galloping inflation, this occurs when prices rise by more than 10% annually, destabilizing economies and deterring long-term planning. Hyperinflation, exceeding 50% monthly, hyperinflation erodes currency value, exemplified by Venezuela's recent crisis where paper currency was repurposed for crafts. Stagflation. Stagflation combines high inflation with stagnant economic growth and elevated unemployment, posing complex policy challenges. Having explored the various types of inflation, let's now examine how inflation impacts individuals, businesses, and economies on different levels. Reduced purchasing power. Inflation diminishes the real value of money, disproportionately affecting those on fixed incomes. Impacts on savings and investments. Savings. Inflation erodes the real value of stored wealth if interest rates lag behind inflation. Investment. Inflation-resistant assets like real estate or stocks become attractive, though uncertainty can stifle overall investment. Wealth redistribution. Winners. Borrowers benefit as the real value of debt decreases. Losers. Creditors and savers face real losses in wealth. Socioeconomic inequality. Lower-income households, spending a higher share on essentials, are hit hardest by rising prices, widening inequality. Global competitiveness. Inflation raises export costs, reducing competitiveness in international markets. Technological impact on inflation. Advancements in technology help reduce production costs and improve efficiency, often mitigating inflationary pressures. For example, automation in manufacturing can lower labor costs, and innovations in logistics optimize supply chains. Climate change and inflation. Climate change introduces new challenges by increasing the frequency of natural disasters, which disrupt supply chains and raise costs. Understanding the effects of inflation is crucial, but what's even more important is knowing how to manage it effectively. Let's explore the strategies used to control inflation. Governments and central banks employ diverse tools to regulate inflation. Monetary policy. Interest rate adjustments. Higher rates curb borrowing and spending, cooling demand. Open market operations. Central banks control liquidity by buying or selling government securities. Reserve requirements. Altering the reserve ratio affects lending capacity and money supply. Fiscal policy. Reduced public expenditure. Lowering government spending tempers demand. Tax adjustments. Increasing taxes curtails disposable income, reducing consumption. Supply-side measures. Investments in productivity and infrastructure mitigate cost-push inflation by stabilizing supply. Inflation targeting. Setting clear inflation targets, typically around 2%, helps anchor public expectations and ensures consistent policy execution. Indexation. Tying wages and pensions to inflation shields vulnerable groups from its adverse effects. Practical advice for individuals. Diversify investments, include inflation-resistant assets such as real estate, commodities, and inflation-indexed bonds. Maintain emergency savings, ensure liquidity to handle unexpected price surges. Adopt energy efficiency, lowering household energy costs can mitigate the personal impact of inflation. Now that we've covered the strategies to manage inflation, let's take a closer look at real-world case studies to see how inflation has played out in different economies. Zimbabwe's hyperinflation. Uncontrolled money printing in the 2000s resulted in hyperinflation, rendering the Zimbabwean dollar obsolete. U.S. Great Inflation, 1970s. Oil shocks and monetary policy missteps drove inflation, resolved only through aggressive interest rate hikes under Paul Volcker. Japan's deflation. Triggered by asset bubble collapses in the 1990s, Japan struggled with stagnation despite extensive fiscal and monetary interventions. Statistical data from 2020 to 2025 highlights variations in inflation trends among emerging economies and developed nations. For instance, India experienced inflation spikes due to energy price shocks, while Germany maintained lower rates through stringent fiscal policies. Inflation, a multifaceted economic phenomenon, requires nuanced understanding and adept management. While moderate inflation stimulates economic vitality, excessive or volatile inflation poses systemic risks. Policymakers must balance monetary, fiscal, and structural measures to mitigate inflationary pressures and ensure sustainable growth. For individuals, staying informed and adapting financial strategies is crucial to navigating an ever-evolving economic. Thank you for watching. Have you felt the effects of inflation in your own life? Let us know in the comments. Don't forget to like, subscribe, and hit the notification bell for more videos. See you next time.